All right, everyone, it's time for another market update. In this video, I'm going to fundamentally break down using macroeconomic data what the hell is going on in the currency markets, what's happening in the stock markets, why has crypto been going up, why has gold in the last week been going down, what is fundamentally driving the markets, and it's all down to what the hell is happening in the United States with interest rates, where is inflation going, and what are central banks doing next. I'm really going to break down how the bond market, so the expectations for interest rates, is having an effect on every asset class. Once you watch through this video, it will really help you get a fundamental understanding for where the currency markets are going, crypto, stocks, commodities, it doesn't matter. It applies to everything. All right, so I hope you enjoyed this video. Please let me know if this video adds some value to your trading. Like, comment, and subscribe to my YouTube channel. And hopefully come into the Telegram channels where I trade, thousands of members in there, and hopefully I'll be trading with you soon. Okay, everyone, so let's break down the stock markets based on what's happening in the bond markets, because it's driving the stock markets because of the market's expectations of what is the Federal Reserve going to do with interest rates in the United States. Okay, so what I'm going to do, first of all, I'm going to break down with you guys fundamentally what the hell is happening in the United States and why the bond market is going higher, pricing in even more interest rate hikes by the US Central Bank because the US economy is just so strong, and how this has a direct impact on how the stock markets perform. Okay, so what we need to understand that in 2022, the Federal Reserve started raising interest rates. Okay, in March, they started raising rates from 0.25%, and they started going up in 0.25%, then 0.5%, and then 4 interest rate hikes in a row where they raised interest rates by 0.75%, which is not normal. Okay, why did the US do that? Because inflation in the United States was out of control in 2022. The US Central Bank, which is the Federal Reserve, has a 2% inflation target. And by March of last year, inflation was at 8%. They was expecting inflation to fall back down to 2%, but it wasn't, and it continued to rise. So the Fed had to do something. They started raising interest rates to try to bring down inflation. Why would they do that? Well, just think about it. People's mortgages, credit cards, car loan payments, as they all go up at the same time, people have less disposable income. They're less likely to spend money in the economy, and that would mean they would cut back on spending. Prices would then drop because the demand for goods and services have gone lower, and businesses would hopefully get rid of workers and then lower their prices to attract back customers into the shop floor or to purchase their services. Okay, so if we look at what happened in the US in March 2022, they started raising rates, as I showed you over here, March 2022. Okay, now what happened with the stock market? If we look at that exact same period of time, let's just break it down into two charts. The stock market started to go down in 2022 when the interest rates were going up. Okay, why is that? It's because if you're understanding the stock markets, what we need to look at is that the bond market has a direct impact on the value of the earnings of companies. Okay, it's called the real rate, okay, of interest adjusted for inflation. So what you're looking at is when investors are determining whether they want to buy stocks or sell stocks, if stocks are attractive, it's because they're looking at the interest rate on a 10-year government bond, they're adjusting that for inflation, and it's called the real rate of interest. And that real rate of interest is affecting the price investors are willing to pay for the earnings of companies. So look what happened. You can see when I put my finger on the right-hand side, you can also see the line on the left-hand side. And that's what happened. And you can see in 2022, the bond market was pricing in these interest rate hikes by the US Central Bank. So the bond market started to attract investors to buy government bonds instead of buying stocks, because as interest rates go up, it means that companies can't borrow money cheaply. They now have higher interest payments, and they know that consumers are going to cut back on their spending because they can't afford to spend as much money. So as the bond market was pricing rate hikes, look at the left-hand side, the stock market was going lower. Okay, can you see this? And this is really important to understand, because there's no coincidence that when inflation started to drop in the United States in 2022, it started to drop after July. We had 3 months of inflation falling. By September, and then core inflation, which is really important because the central bank watches core inflation more than headline inflation. And core inflation is basically inflation excluding food and energy prices, because the central bank can't control food and energy prices because that's set on an international market. So what happened was in September, inflation came down for 3 months in a row. And more importantly, inflation expectations actually peaked in September at the same time when the headline inflation had gone down for 3 months in a row. But because inflation was falling, now investors expected that inflation expectations for the next 2 years would also come lower. And this was really, really important for the markets, because as soon as inflation was on its way down in 2022, the markets were then betting that the Federal Reserve would cut interest rates at the end of this year, 2023. So they started to price this into the bond market. And you can see the bond market's interest rate hikes peaked around October 2022. And look what happened to the stock markets. As the bond market started to price in rate cuts, the stock market took off. Okay, because the price that investors are willing to pay for the earnings, and I've done a separate video on this on YouTube, the importance of understanding inflation and real rates of interest, which is just basically a bond paying paying a certain amount of interest. When you adjust that for inflation expectations, more importantly, this literally drives what happens in the stock markets. Because look, in the bond market started to price in rate cuts, and you saw what happened. The stock market started to rise. Okay, you can see at exactly the same time as the bond market price and rate cuts, stocks took off. So all you ever need to know about stocks, if you really want to understand it in just a nutshell, if interest rates come lower, it makes stocks more attractive because the earnings of those companies are becoming more attractive to investors because they're worth more. And you can watch the separate video on YouTube to understand this whole calculation. It's really important for you to understand. All right. And then something happened recently. As of the 3rd of February, the jobs data in the United States literally came out and showed such a strong month for US employment. 500,000 jobs were added. The unemployment rate went low. And then the markets were realizing that the US economy is so strong that companies are not actually letting go of workers at the pace they were expecting. And they knew straight away the Fed is going to have to keep raising rates a bit higher than they were expecting to slow down this jobs growth. Okay, and look what happened. The bond market went up again, priced in another rate hike, and there's no surprise, that's when the stock market has flatlined. All right, so just look and remember this. It's very important to understand. When the bond market's pricing rate hikes, the stock market goes down. When the bond market pricing rate cuts, the stock market goes up. And at the moment, they've priced in another rate hike and the stock markets have flattened. If this bond market keeps going higher, the stock market will go lower because the value of future earnings is dependent on this interest rate adjusted for inflation. And the adjusted for inflation number is actually, if I show you this here, the real rate of interest. Okay, so look, there's no surprise, it reached its peak and that's when the stock market started to rally. Okay, it's gone up a bit recently and the stock market has flatlined. So moving forward, to know what's going to happen with the stock markets, what we need to pay attention to, most importantly, is where is inflation going? It is going down at the moment. Headline inflation is coming down and core inflation is coming down, which is really good. And hopefully, if inflation expectations decline, then you know what's going to happen. The markets are going to price in rate cuts, which they're still pricing in towards the end of the year. Okay, so this will be driving where stocks go next. And this is actually really important to understand because if you're trading cryptocurrencies as well, this is something you should learn. Crypto move at exactly the same time as stock markets. Because look, if I show you the crypto markets, there is no surprise. Look what happened over here. When the stock market was rising over here, so was the crypto markets. Can you see? And in 2022, when the stock markets are going down, look at the crypto chart, that's when the crypto markets were going down. And previously, when the stock markets were going up, as you can clearly see here on the left-hand side, so was the crypto markets. They move so much in correlation that every time you get a pullback in the stock markets, you actually get a pullback in the crypto markets, which is really important for you to understand. So look, stock markets fluctuated here and had a little 5% pullback. And look what happened at exactly the same time in the crypto markets, pullback. Stock markets went higher again. We had another pullback in the stock markets around here. No surprise, we had another pullback in the crypto markets. Stock markets kept rallying higher again. We had another pullback here in the stock markets. We had another pullback in the crypto markets. And then stock markets reached their peak and started to decline. No surprise, crypto's gone all the way down. So for us to know where the stock markets are going and the crypto markets, all we need to understand is where is inflation going, the expectations for inflation, and then where is the bond market going? Because as I've showed you, it affects stocks and crypto moves in line with stocks. So we need to look at inflation data, understand what the markets are expecting for inflation, because that's going to affect where they expect interest rates to go, and the bond market is always going to price this in straight away. Really important to understand this. This is what drives the markets. If you really want to understand PE ratios, so the price investors are willing to pay for the earnings, which is affected by the real rate of interest, watch the separate video I have on my YouTube channel, because it will really break it down and it will really help you understand the stock markets driven by the bond markets. All right. So now we're going to turn on to the currency markets and look at how the currency market is also being driven by interest rates and the bond market. All right, everyone. So let's have a look at the currency markets and see what's happening. And it's actually being driven by exactly the same thing as I was just showing you in the stock markets, and that is interest rate expectations, and especially what is the Federal Reserve going to do next in the United States because of the inflation situation. So if we look at Euro USD, we saw the dollar last year was on a very strong trend against the euro. It was going all the way down until the euro started to go higher against the dollar around September. But no surprise, the dollar started to weaken. When what happened in the bond market? The markets were pricing in rate cuts. Okay, so I previously touched on in the last video that inflation peaked in July and started to go down by September, and core inflation started to go lower by October. Okay, so around September, October, you saw inflation going lower in the United States, and so did the expectations for inflation also start to decline around September, October. And there's no surprise, that was when the bond market started to price in rate cuts at exactly the same time, and that's when the dollar weakened against the euro. Same situation with the dollar against the Japanese yen. We saw the yen getting weaker against the dollar at exactly the same time, and even the pound has been going up against the dollar at exactly the same time as the bond markets were pricing rate cuts. Okay, so the interest rates expectations in the US literally also feed into the currency markets, because we have to remember, okay, that in 2022, for an example, the yen got so weaker against the dollar, we saw a 40% move in the dollar's favor, because, for an example, in 2022, when the Fed was raising interest rates to bring down inflation, you had countries like Japan that wasn't raising interest rates, because look at Japan's inflation during the same time of last year. It wasn't out of control. It was still very low. So the central bank in Japan, which has actually had an inflation problem for 30 years, said, we're not raising interest rates. It's not a problem. So as the bond market was pricing in all these rate hikes by the US central bank, and we saw the bond market going up in value in terms of higher rates in the United States, well, what do you think investors in Japan were doing as these rates were going up? They're selling Japanese yen, buying dollars, because Japan is the number one holder of US government bonds, because Japan just doesn't pay any interest. Think about it. If you're a Japanese investor, what are you getting paid on Japanese bonds? Nothing. 0% interest. Okay, compared to the United States at that point last year, that was paying 3-4%. So the dollar was getting stronger against the yen as rates went up. The dollar was getting stronger against the euro as rates went up in the United States, because the European Central Bank didn't start raising rates until July. So that was lagging the United States. And again, if you're a European investor and rates are going up in the US, where are you going to put your money? In the United States. Okay. So when looking at the yen against the dollar, the pound against the dollar, the Aussie dollar against the US dollar, these currency moves are all being driven by the bond market. Can you see here when the bond market went down on the right hand side? That's when the Aussie dollar started to strengthen against the US dollar. Why has the Aussie dollar weakened recently against the US dollar, as we can clearly see here? No surprise, because the bond market has gone up. And why did the bond market go up? Well, I showed you over here, because the US jobs numbers were so strong, okay? Meaning that the US central bank isn't causing businesses to let go of workers. It's causing businesses to actually hold on to workers, because they're afraid if they let them go, it may be difficult to get them back if the US does tip into a deep recession. So now the markets have priced in another rate hike by the US central bank in July, as I've shown you here in the bond market. On the right hand side, why bond yields are going higher. That's why the dollar is getting stronger against the Aussie dollar. That's why the dollar is getting stronger against the British pound. That's why the dollar is getting stronger against the euro. That's why the dollar is getting stronger against the Japanese yen. So all we need to look at when we're looking at the currency markets, where the hell are interest rates going? And it applies to the same formula which I was showing you earlier, and that is based on Where is inflation going? Is it going lower, or is it taking its time to go down? Is the unemployment rate going up? If it keeps remaining low, the Fed's going to say, we just need to raise rates even more to crack the jobs market. And when I say crack the jobs market, what the Fed wants to do is cause businesses to lose out on profits because they're paying so many wages to their employees who are not spending, and the public are not spending as much money because they can't, because interest rates are going up. Businesses start to lose revenue. What do automatically? Get rid of workers, lower our wage bill, get rid of workers. Now more people are unemployed looking for work. Now businesses don't have to compete with each other as much. They can now have a better choice to look and find workers, and they can offer lower wages. Soon as companies start to lower their wages, they can bring down prices. That is what the Fed is trying to engineer. They're trying to see if core inflation comes lower because people are not spending money, the unemployment rate goes up, wages go down, and that should bring down the inflation rate. And also bring down inflation expectations. Because if inflation expectations start to go back down towards 2%, people demand higher wages from their employers, and that can help the central bank get inflation back down to 2%. And that's going to be the key driver for where interest rates go. And where interest rates go is going to affect the bond market. And where the bond market goes is going to affect currencies, going to affect gold, for an example. I've done a separate video on gold, so please go watch it. It's really going to help you understand what the hell's going on. So moving forward, that's what we need to understand. Where is inflation going? What's happening with the jobs market? How are the markets expecting the Fed will react? And that's going to affect the bond market, which affects everything from currencies to gold to cryptocurrencies to stock markets. They're all affected by the bond market. It's the most important component of markets that we have to watch. If interest rates are going up, money is more scarce, there's less liquidity, there's less spending, there's less growth. If interest rates go down, positive, okay? Stocks go up, crypto goes up, gold goes up, the dollar goes down, okay? Because again, interest rates literally drive currencies. If I show you this spreadsheet here, you look at the currency markets, you can look at this blue line, which is just a difference between interest rates in the US and Japan, and the exchange rate follows this difference. If it's going up in the US's favor, as we saw from 2020, the dollar marched higher against the Japanese yen. And I'm talking huge moves against the yen. Let's have a look at that 2-year period when the dollar yen didn't just go up in 1 year. Look how much it went up over a 2-year period from 2021 to 2022. It went up 50%. Why? What did the bond market do? At exactly the same time, the bond market started to go up in value. The interest rate started to go up. Why? Well, you already know. I showed you over here, guys. Inflation was getting out of control. The Fed had to do something. They started to raise rates, and it attracted money into the United States. Okay, so it's the flow of money between countries which is really driving the currency markets. You can see it here with the yen. You can see it here with the Swiss franc. Look, they literally follow each other. Interest rate differentials cause currency markets to move. Euro USD, no exception. Okay, the pound against the dollar, no exception. Apart from when Liz Truss crashed the pound, you had a little divergence. All right, so this is fundamentally what the hell is going on, okay? If you really want to trade currencies, we need to be paying attention to the macroeconomic fundamentals for what the hell's going on, because it's going to affect what the hell the market does, and it's all down to interest rates. All right, so I hope this video made sense. I know it's a lot of information to take in, but you need to be on top of it to know where markets move next. All right, guys? So if you enjoyed this video, again, please like, comment, and subscribe. If you're interested in learning about trading, come and get in contact with me or join my trading team. You're more than welcome. All right, everyone, have a good day.